a bill for disaster relief, Senator Yee's bill, SB 21. So first, let's call the roll.
Senators Wolk.
Here.
Senator Walters. Alquist. Ashburn.
Present.
Padilla.
Present.
All right, we do have a quorum. Let's move on. Senator Yee, welcome, and thank you for bringing this forward.
Thank you very much, Madam Chair and Senators. On September 9th, 2010, a gas explosion resulted in a large fire that occurred in the city of San Bruno due to a ruptured PG&E natural gas pipe. The disaster was declared a state emergency. Because of that particular disaster, there were 8 fatalities and 37 homes were destroyed and many others of varying degrees of damage. The current estimate of the damage to homes and vehicles is over $55 million and does not include the public infrastructure recovery costs for the event that already exceeds $15 million. As you know, these residents who lost their homes and other lives and have really been extremely devastated, and there are many efforts, but our small effort is represented in this particular bill, SB X 621. The bill will do things. One is that those individuals who have lost their homes technically no longer would be receiving a homeowner's tax exemption. This bill will allow them to continue to do that for 1 year. And then secondly, as you can imagine, the local communities are extremely devastated because of the homes gone, other structures gone, and so cities and school districts no longer receive revenue or taxes from those lost structures. And what this bill will do is to allow them to continue to receive those particular funding for 1 year. And then those individual businesses and personal individuals who have had losses, they will be able to take that off their income tax. And so, let me just say that this is a small effort on our part. Repairing lives and bringing back lives is something that you just can't do. And so hopefully with this, it will ease that pain a little bit. And with that, let me ask the city manager of San Bruno to say something.
Okay. Welcome.
Thank you. My name is Connie Jackson. I'm the city manager of San Bruno. The senator stated very well the basic facts of what occurred in our town. What words really fail is to adequately describe the devastation and the difficulty that our community, our residents, and indeed our region are experiencing in dealing with the results of the devastating pipeline eruption and fire that occurred following. Simply stated, there were 37 families in San Bruno. There are 37 families in San Bruno who have lost their homes to total destruction. Those homes no longer exist. 51 families have been left with either moderate or significant damage to their homes. 18 of those families are still at the 1 month mark, now coming up very soon, unable to return to their homes because of the significance of the damage that their homes experienced. 65 persons were injured, and as the senator indicated, 8 persons tragically lost their lives. There remain numbers of individuals, roughly 6, that remain hospitalized with very, very serious injuries. Again, the results of the the results can barely be imagined in a quiet residential neighborhood such as the Glenview neighborhood in San Bruno once was. The city and its residents are rapidly embarking on the immediate recovery phase of this disaster situation. The area is being cleared, and we are rapidly in the process of putting together programs and support services for those families that have been most devastatingly affected, with one-on-one assistance through our city organization in partnership with all of the regional agencies and nonprofits. What remains as a major challenge, both to the families that I represent as well as the City itself is and this is only really one aspect of the challenge that we all jointly experience, is the financial consequences of this disaster. For the families, obviously, their lives have been shattered. They face a long and difficult process of rebuilding any sense of normalcy or any reestablishment of financial stability that they might have once enjoyed. For the city of San Bruno, a relatively small city, I think I don't need to give you the gory details about our financial situation. Suffice it to say that it mirrors that of many others, the state itself, and many other cities up and down the state of California. We have an approximate $30 million budget. We have a modest reserve fund of approximately $5.5 million. I actually was startled one evening in the early aftermath of this event in talking with our partners at CalEMA to hear about the process of seeking state and federal grant resources for reimbursement of some of the costs. As the Senator aptly pointed out, those costs now exceed, and are growing every day, now exceed approximately $15 million. That is, as I indicated, well outside the reach of the city of San Bruno to manage or to even begin to imagine being able to cover. Our $5 million reserve, as I started to say, one evening I was up at the site, I met some folks from CalEMA and was beginning to talk about the state and federal assistance processes. And when I heard that only a portion of our costs, only a percentage, might ultimately and optimistically be covered by those reimbursement resources, I said, well, where does the rest come from? And they said, from your reserves. But I guess it goes without saying that we would never have imagined the potential for such a devastating situation in the city of San Bruno, nor the ultimate financial responsibility that is now in front of us. So we are here today in support of Senator Yee's proposal. We appreciate all of the various legislative proposals on the myriad of issues that are being forwarded both through our state legislature as well as through Congress, and we look forward to working with you in the future to rebuild San Bruno. Thank you.
Thank you. In support?
Good morning, Madam Chair and members. My name is Joel Morris. I'm a Deputy Assessor with the County of San Mateo. I'm here on behalf of Assessor Warren Slocum. First, we'd like to thank the committee and for hearing this bill, and for Senator Yee for its introduction. As the Senator stated, and as Ms. Jackson also stated, the residents of San Bruno have suffered great losses as a result of this calamity. This legislation will help ensure that homeowners and the county do not suffer from a reduction of property values due to the fire. The county has already spent nearly $500,000 in services towards this cleanup and repair, and that's just the beginning. We feel that this measure provides much-needed relief for our county.
Okay. Thank you.
Good morning. Thank you, Madam Chair and members. Gus Corey here on behalf of the San Mateo County Transit District. The district did its small part in providing public transportation to assist with the evacuation of the impacted area. We stand together as a community, and we applaud the Senator for providing this modest proposal, which will help people get back on their feet, and we ask for your support. Thank you.
Further support? Come forward.
I'm Estelle Lemieux with the California Teachers Association. We support this measure. We appreciate the Senator keeping schools whole with the loss of property taxes. This is, would be really exacerbate the schools in that area in terms of more cuts. So we appreciate that we're going to be kept whole. Thank you.
Thank you. In support?
Madam Chair, members, Jean Hurst on behalf of the California State Association of Counties, also in support.
Thank you. Further support? Is there opposition?
Question.
Question, yes. Senator Ashburn.
Senator Yee, thank you for stepping forward to offer some relief to the people affected. Has a responsible party been identified as related to the cause of the explosion that brings us here today?
Unfortunately, right now, no. I do know that Senator Padilla and Senator Leno, they are planning to hold hearings on the cause of this particular explosion, but until that hearing and maybe some further review by the federal government, we do not know exactly the cause of this particular explosion yet.
Well, the reason for my question is that, the pipeline that exploded is the property of PG&E, and questions have been raised about maintenance of the pipeline and the adequacy of protections to prevent such a disaster and the incredible harm to the people. The loss of life and the injuries are, just beyond description. The result of your bill is to actually reduce the amount of revenue that would come into the county of San Mateo. And I support the bill because it grants tax relief to the affected residents. But at the very time that the city manager is describing, and I'm sure the county officials could describe the need for revenue to help in the rebuilding process and all the related aspects, this bill will reduce those revenues, and yet there's a responsible party out there. And I'm just wondering what their role is going to be in making whole not only the residents, but the county, the city, and all the other beneficiaries of the tax revenues that are affected by the bill.
I think it's a two-part question. I think the first part of denying the county revenue, I think the reality is that because these structures are gone, the homes are gone, the county would not receive any of those revenues whatsoever. So they wouldn't get any. I think more to your point about holding the individual responsible and for them to make the county whole and other individuals whole. I would like to think that we would be able to resolve this right away. I'm not sure that that's going to happen. If at some point we do, in fact, find out the true cause of it and then go after those individuals responsible for the true cause and get whatever compensation out of that, maybe at that point we can kind of look at, do they repay the state for these particular funds that we are now issuing out or the allocations of dollars to the county. But my concern for the residents is right now. I mean, you've got residents and you've got counties and you've got cities and schools that are worried about what's going to happen to them. And having some kind of a determination and some exactness in that future, brings them a lot of comfort. Let me just say that while there are individuals who have lost their home, there are those individuals who are in sort of that in-between situation where they did not totally lose their home, but yet they cannot occupy it. They've got holes in their ceilings or in their roof and what have you. Those individuals are even in a more precarious situation because they're not sure, do they rebuild or do they not rebuild? They've got to deal with contractors. They've got to deal with inspectors. They've also got to deal with their jobs. And so they're even in a more precarious situation because they're in that sort of never land about what exactly am I going to do. This bill will at least provide them with some definite indications of their financials down the road, and hopefully with that provide them with at least some sense of comfort.
Senator Padilla.
Thank you. Along the same lines, I'm absolutely supportive of the bill, especially coming from a district in Los Angeles where we're all too familiar with earthquakes and fires and floods and numerous other types of disasters. So relief to the residents is first and foremost. an appreciation of Senator Ashburn's comments. Number one, as chair of the Senate Energy, Utilities, and Communications Committee, I know I've talked with Senator Yee about an upcoming hearing that's been announced, where we will, Senator Ashburn, get into the details of, what was going on, both at a PUC level in terms of oversight and accountability, as well as the PG&E level from a maintenance and safety point of view. What did PG&E know, and when did they know it? Kind of conversation. But as far as the residents go, I think first and foremost they need to know that relief is on the way, and to the extent that, based on findings that will come, whether it's ultimately relief at the expense of PG&E or relief at the expense of the county or the state or whoever, the residents just need to know that relief is on the way, and we'll figure the rest out in due course. So I just wanted to sort of acknowledge the agreement with Senator Ashburn's concerns, the hearing that's coming up to try to get to those very questions, but to side with you in support here for responding to the residents as soon as possible.
I think my colleagues have spoken eloquently and to the point. We want to do as much as we possibly can now as the larger issues are being sorted out. So, Senator Yee, if you'd like to close.
Thank you very much for your help on this particular bill, Senator Wool and your staff, and with that, urge an aye vote.
All right. Is there a motion? Been moved by Senator Ashburn. Please call the roll.
Senators Wolk,
Aye. This is due pass to appropriations. Aye.
Walters, Alquist, Ashburn,
Aye.
Padilla.
Aye.
Why don't you call the roll?
Senator Alquist.
This is the San Bruno bill.
Aye.
Vote is 4-0.
4-0. That bill is out.
Thank you
This
very
will
much.
Move to appropriations. Thank you. All right. We will now move to the informational portion of our hearing. And why don't we, Colin Grinnell, who is the consultant to the committee, will be presenting this morning. We know that the leaders of each caucus and the governor worked very hard to forge this budget agreement, which will affect citizens greatly and is very necessary. I was asked I asked the pro tem if we could have this informational hearing to collect information from the public and hear from the public regarding the budget agreement's tax proposals, and to bring a little sunshine into the trailer bill process. And I'm hopeful that this hearing will help the members as well as the public learn about the specific proposals in the trailer bill. Colin Grinnell, who is with the Revenue and Tax Committee, will detail the proposals. There are, in fact, 6. And we will focus most of our attention on 3, but I will ask Colin to do an overview of all 6. He will be assisted in that by representatives from the BOE and the FTB, and I think if they're here, where are they? Come on down. You can sit up at the dais, or probably up at the dais, because we'll have people speaking. Welcome. Certainly ask you for your estimate as to the fiscal implications as well as the ease or not of administration and application. We will take support and opposition on the individual proposals in the order of the analysis, primarily focusing on the 3 major proposals: the exception to the NOL suspension, the changes to the intangible sales known as cost of performance, and the third being the changes to the large corporate understatement penalty. As I said, there are 3 others which Colin will go through, which Mr. Grinnell will go through, and if there are any comments about those, we will take those at the end. There will be public comment at the end, but we will take support and opposition with each individual major tax proposal. So with that, I think we'll begin. I want to welcome Steve Shea from the Pro Tem's office. And we will now proceed. So.
Thank you, Madam Chair, members of the committee. Colin Grinnell, consultant to the Revenue and Taxation Committee. I will give a brief overview of the 6 major components as part of the budget agreement. Starting first with Section 1, net operating loss suspension. The state has suspended NOLs in the 2008-2009 tax years as a result of AB 1452 in 2008. This measure would also provide a similar suspension for the 2010 and 2011 taxable years, as well as extending the delays, as well as delaying the net operating loss carrybacks for 2 years later than they otherwise would have taken effect under the law at that time. There are some technical and conforming changes to these sections that the measure also makes. The bill allows a exemption from the NOL suspension for personal income taxpayers with less than $300,000 in modified adjusted gross income, or corporate taxpayers with less than $300,000 in pre-apportioned income. This is a slightly modified small business exception from the 2008 and 2009 suspension, both in definition, and it also lowers the threshold from $500,000 to $300,000. Section 2 provides an exemption from those NOL suspensions for 2008 and 2009 for taxpayers meeting specified criteria, which are listed in the bill. If firms are eligible for this, they would file an amended return with the Franchise Tax Board that would be treated as an original one. The measure also contains a public purpose statement necessary to effectuate this provision. The third provision of the bill modifies the large corporate understatement penalty, which was enacted in the legislature again in the fall 2008 budget agreement. This understatement penalty applies to understatements of tax on original returns of $1 million or more. The modification provides a dual standard that triggers the penalty, whereas it was once $1 million. The budget bill amends the threshold to only trigger the penalty if the understatement both exceeds $1 million and exceeds 20% of the taxpayer's tax liability. So it will, the penalty will apply to a smaller population to which it previously applied to. The fourth change the bill makes is to the sourcing of sales of intangibles and services. For this provision, it's probably easy to keep in mind what existing law was from 1966 to 2010. What existing law becomes by virtue of the February 2009 budget agreement, SB X315 and AB X315, and then what's proposed in the bill. From 1966 to 2010, all taxpayers inside the state and outside the state sourced sales of intangibles by using the cost of performance method, which meant that the taxpayer sourced these sales to whichever state the income-producing activity took place. So whatever the taxpayer did to develop the intangible, to develop the service, that is the state to which the taxpayer would source that sale. ABX 315, SBX 315 changed from cost to performance to what is widely known as the market rule. So for all taxpayers, these sales would be sourced to California if the service or intangible was used in California. The so-called market rule. The proposal modifies this threshold, which would have taken effect in 2011, to essentially have the sourcing of intangibles follow the sales factor election. In California, effective in the 2011 tax year, taxpayers may choose to apportion income to California using the traditional three-factor double-weighted sales method, or can apportion income to California using only the sales factor. What the bill does is it says that if you apportion income using only the sales factor, you use the market rule to source sales of intangibles. If you use the traditional apportionment formula, you use the cost of performance method to allocate sales. The analysis goes into a more thorough discussion of this, but this would also take effect for the 2011 taxable year. The measure also makes two other changes to enhance collections for the Board of Equalization. The first of which is to bring back onto the income tax form the ability for taxpayers to report outstanding use tax that they normally would have to report to the Board of Equalization directly. And it also allows the BOE to assess a cost recovery fee under the sales and use tax and all the other various fees and taxes that they administer. You can find the fiscal effect of the bill on page 7 of the analysis, and franchise tax could speak more specifically to those estimates.
Okay. That's a good overview. Now I want to go back through those and ask the following questions. Again, focusing on the fiscal impact. And again, if the committee has any questions as we go through each one, plenty of time to do this. Its fiscal impact, how much does it cost, and when? So the duration. Budget year, next year, or the year after. With some of these, I'd like to know about the ease of administration. Is this an easily administered change? I mean, how exactly is it going to work? Question as to vote threshold. Are these changes that can then be in the future altered or changed? If so, how? Majority or two-thirds. And then any other foreseeable or unforeseeable impacts, dynamic or static. We've certainly heard those words in this committee before. The basic effects. So if there are any other questions, I'm sure there'll be more, and I'm sure there's there will be plenty of comment from support and opposition as well as the public, but let's at least start with that. So let's start with Mr. Grinnell, the largest, which is the NOL suspension, the delay of 2 years.
Okay.
What does that mean to the state of California? What does it mean to our budget?
The estimate I have from Franchise Tax Board.
And franchise tax, just if you would rather they do it, that's fine. Whatever.
No, I'm happy to do it.
Okay.
According to the Franchise Tax Board estimates for the NOL suspension is an increase of $1.2 billion in 2010-11, increase of $410 million in 2011-12, a loss of $205 million in 2012-13, with diminishing losses going into the future.
All right. And is there an administrative issue here at all?
We're kind of popping up here.
Come on, pop up. Come up. Yes. Welcome. I think you should identify yourselves.
This is Patrice Gow-Johnson from Franchise Tax Board. It does require us to change forms and instructions, but we do that annually, so it's all part of the job.
Something you're used to. Part of the job. I love that. Okay. All right. Yes. Did you have something to add?
Not on that, on the NOL issue. No.
All right. Let's look at then the exception to the 08-09 NOL suspension. What are we talking about in terms of cost?
For this item, FTB could not provide an estimate because it was specific. It's too specific to taxpayer-sensitive information, so they were unable to obtain a revenue estimate for that provision.
Do we have an educated guess?
I would imagine perhaps the supporters of the bill could tell us what the impact is for the taxpayers seeking the exemption from the suspension.
All right, and we'll ask. So, what is the issue of the? What is the issue here that prevents us from knowing exactly what?
Ann Maitland for the Franchise. Ann Maitland for the Franchise Tax Board. Franchise Tax Board is bound by law and by policy to observe taxpayer confidentiality. And when there are too few taxpayers affected by a particular provision, we are unable to provide a revenue loss or a revenue gain associated with the tax change.
Okay. All right, and that is the duration of this particular provision. proposal is 1 year. 1 year? 2 years.
Yeah, the impact would be in 1 year for the taxpayer to claim NOLs under the exception that they otherwise would not be able to claim, but for the legislation. So they would be able to offset a 2008 capital gain with NOLs that were suspended. So the impact would be to immediate and would not be ongoing.
All right. And in terms of administration, how does this happen? Just the taxpayer who feels that they are eligible for this would then
file a return with that information. We're still looking into our program areas exactly how they would handle, but it's still open. But we just it would be part of the filing of their income tax return.
Okay. All right, then we'll look forward to the supporters and opponents on this, but I want to go through these, and then we'll, again, go back again through for supporters and opposition. Mr. Grinnell, you did I listed the cost of performance next, but in fact, in the analysis, it's the large corporate understatement penalty. Let's go to that one first.
Okay, the most current numbers we have with a 2011 effective date indicate revenue losses of $40 million in 2010-11, $90 million in 2011-12, and $100 million in 2012-13.
All right. And explain that. Explain once again the differences. What are we changing?
What we are changing is the application of the large corporate understatement penalty, which is a 20% penalty on any understatement that exceeds $1 million on a taxpayer's original return. It doesn't apply to amended returns or claims for refund. The event that triggered the penalty as the bill was enacted was this. It was one thing. If you understated your tax liability by more than $1 million, then you'd be penalized 20% of that understatement. Under the bill, that would still apply so long as the taxpayer's total tax liability, the $1 million, didn't exceed 20%. Under the bill, the understatement has to both exceed $1 million in aggregate, in total understatement, and then the understatement must constitute at least 20% of the taxpayer's total California tax liability. So you'll have a fewer amount of understatements to which the penalty will apply in the future.
So how large a corporation, a business enterprise are we talking about here?
Okay, I did some, I clearly am not a math whiz, but I did do some calculations in page 14 of the analysis. So in order to have $1 million in tax liability, you need to have about $11.3 million in income. So 11.3 times the 8.84 rate gets you to about $1 million. So if you reported zero and your tax liability ended up being $1 million, then the understatement would be $1 million. So the only firms that could apply to would be those over $11.3 million in California taxable income. If you raise the threshold to 20% of the firm's liability, my amateur math skills indicate that $56.5 million in California income multiplied by the tax rate leaves you with $5 million in tax, and so $1 million would be 20% of your liability. So only for those firms that had more income than that would have a possibility of making an understatement that would be over $1 million, yet less than 20% of their liability.
Now, you made an estimate as to what that would cost. So you have a good sense then of how many firms this might apply to. We're making how are we coming to that estimate?
Madam Chair, first, we were not aware that the proposal applies to tax years beginning on or after 2011. So I can't verify the revenue estimates that Mr. Grinnell was referring to, in part because we've done so many that They could be right. It could also refer to a manufacturing credit. At the moment, I can't tell you, but I will get back to your staff about that. But basically, we worked on a sample of large corporations in preparing all of the estimates relating to LCUP, to the large corporate underpayment penalty estimate. And in our sample, we're well over 100 corporations.
All right. Is there any change in the proposal to the standards that are normally used, either with respect to penalties, interests, or strict liability on these?
Not by my reading.
No? Okay. And how is this goes on? Can it be changed then in the future if it has a different effect than what we expect?
Since this is a penalty, it was enacted at majority vote. And generally with provisions that increase penalties or interest, these are generally not considered increases in proceeds of taxes for the purposes of Section 3 of Article 13A. However, with Proposition 26, as we heard last week, that changes Article 13A considerably. And it would be the determination of Legislative Council whether or not to reinstate the penalty or to add another one would be a majority vote or 2/3 based on enactment of that initiative.
That's interesting. All right. Any other foreseeable, unforeseeable, any other things that you want to say before we go to support and opposition? Moving on to cost of performance.
Okay, cost of performance change in the sourcing of intangible sales. The revenue estimates I have from Franchise Tax Board indicate a revenue loss of $28 million in 10-11, $95 million 11-12, $100 million annually thereafter, if I'm correct. Yes.
Okay, and that continues, and the ability to change or modify that
would be a 2/3 vote. This is a direct change to a taxpayer's liability.
All right. Administration. This hasn't begun yet. We haven't.
Hi, Carl Joseph, Franchise Tax Board. Well, the rule that's being reinstated here is the rule that was in California law for many, many years. So we do have quite a long history with cost of performance. We are aware of how it works and when it doesn't. So by bringing this back, essentially we just keep doing what we've been doing up to now. The new market rule hasn't even started to take effect yet. It wasn't going to be in effect till 1/1/11. So it's the same rule we applied in 10 or 9 or 8. So no problem in the sense of knowing how the rules work.
Sounds like we're saving you money.
Well, the rules are hard to the rules are hard to apply. That's really the only thing I would say on that, is that cost of performance is a difficult issue to audit. It's a difficult issue to analyze. The new market rules may well prove to be difficult as well. We're in the midst of working on the regulations on that, but cost of performance can be a tricky thing and can be somewhat contentious in how you go about it. The major reason for that is because the rule itself is colloquially referred to as an all-or-nothing rule. You look at an item of income, and when you do the analysis, you either assign it to one state or the other. And if it's a big item of income, it can really be of great importance to the taxpayer as to how that analysis is done. So big swings can occur. So from that perspective, cost of performance can be quite factual. It can be quite time-consuming in audit to do that analysis. And certainly is the same for taxpayers trying to do their returns.
Yes, Senator Alquist.
Thank you. What kind of oversight is there for those who determine in which state should be taxed? Who determines that, and who oversees that? And I'm trying to see if there's some kind of pattern, and if you could speak to that.
I'm not sure I quite understand what you mean by overseas.
On the cost of performance, the
Yes.
tax is allocated to one state or another. right? Where it's manufactured or where it's sold, is that correct?
Well,
correct me if I'm not understanding.
This rule applies to services and intangibles. It doesn't apply to sales of tangible property. So generally not to people who do manufacturing. Their rules are simpler. Basically, their sales just go to the destination of the sale, whoever bought the thing, wherever their destination. Mm-hmm. So you're looking primarily at service companies here and companies that have income from intangibles. Now, as far as
it was a little tricky.
Yes,
that's what I'm trying to get at. What makes it tricky, and
yes,
that piece of it.
Sure. The rule itself in the law basically provides for assigning the services or the intangible to the state where the income-producing activity occurred, or if it occurred in more than one state, you assign it to the state where the greater cost of performance occurred. Okay.
That sounds pretty cut and dried.
Well, when you get into the regulations define cost of performance to a certain degree. It's not bad, but they don't really tell you much about which costs to count. It says direct costs. Well, what does that mean? I'll give you a really quick example. If I'm a taxpayer who is in the service of grading a road, I do road grading, and I buy a tractor to do road grading, certainly the purchase of that tractor would be a direct cost to the road grading job I bought it to do. What if I use it to do 3 jobs? Is it a direct cost to all 3 jobs, or is it now an indirect cost because it wasn't purchased but for that one project? You wouldn't have purchased it. You purchased it for many projects. What about overhead? Things like your office, the people who work, the salespeople, things of that nature. It's less than clear how that analysis should be applied. So often we do have issues related to how to define the scope of the costs that are going to be used in that analysis.
So that is an issue?
Yes.
Okay, thank you.
Mm-hmm.
Would you please explain? This is very difficult and complex, and I'm really trying to understand. The bottom line is, what gains does California get or not from this change, California business, and therefore California? I need to know more about intangibles and why is this an important change to make? What's happened to the economy?
Well, in the general economy, as the United States economy has changed, the share of tangibles versus intangibles. The United States now has intangibles comprise a larger source of the economy than tangibles used to. We've shifted to a manufacturing to an informational and service-based economy. So, when they drafted UDIPA and when we enacted the cost of performance standard in 1966, that mix was much different. It was a much more tangible personal property-based economy than it is now. So the importance of this issue is very very large, just because of the share of the economy that it now affects, and that share will grow over time. The change that was made as part of the February 09 budget was essentially to do 2 things. The first of which was to make sure that in-state firms could take advantage of the single sales factor election. If you're an in-state firm and your income-producing activity and cost of performance were incurred in California, then all the sales that you make are going to be sourced to California. If that happens, your sales factor gets very large. So single sales factor probably doesn't make a lot of sense for your firm unless your property and payroll factors are somehow larger than your sales ones. For cost of performance for out-of-state firms, it's a lot easier for them. They're able to sell services into the state, sell intangibles into the state, but don't have to report the sales here. The sales are allocated back to whatever state the income-producing activity or the cost of performance took place in. So the market rule change gives the state a larger share of those sales than they would under the cost of performance method, and because intangibles will grow as a share of the economy, intangibles would decline. The market rule will probably have growth in revenue over time.
Would this? We've talked a lot over the last 2 years in Rev and Tax about tax expenditures and accountability. Is this the kind of expenditure that would, given the fact that it hasn't begun yet and is making some major changes to California corporations, this might be a good one to have a sunset on.
Yeah, I mean, this is not a...
Suppose it doesn't turn out to be this way.
I mean, every state has to make a decision about how to source intangibles, so it's not a tax expenditure in the classic definition of some special provision of tax law that results in a lower tax than would otherwise be under normal functioning of the tax system. But you know, as you said in committee, that sunsets are a great way of achieving oversight over changes in tax law, which we may or may not fully understand the impacts of when considering.
And for this one, changes are 2/3 vote.
Mm-hmm.
Okay. All right. Unless there are further questions, there are two more that we want to look at, and then we'll go back and allow for supporters and opponents to speak at length. This one has to do with reauthorizing taxpayers to report the use tax on the income tax form.
Mm-hmm. According to the BOE, this results in approximately $10 million annually.
Okay, and I assume what's the administrative? I mean, how hard is that?
Well, we've been doing it for the past 6 years.
Well,
we've been doing it for the past 6 years. This has been law. It's sunsetting this year, and we reimburse FTB for the cost of processing the returns. So each year, our costs are attributable to the amount of returns that are filed reporting use tax. So it's a very simple way to collect use tax that wouldn't probably otherwise have been paid.
And you said this is basically doing away with the sunset that existed,
yes.
or reauthorizing.
This makes it permanent.
So it makes it permanent?
Yes.
Okay, so there is no future sunset. And the estimate is $10 million?
Yes.
All right. The last one has to do with authorizing BOE to assess a cost recovery fee.
Yes, and BOE estimates revenue at between $4.8 and $5.9 million in 10-11, and then between $18 and $20.6 million a year beginning in 2011-12.
Okay. Tell me a bit more about it.
Basically, we would be...
Tell me who you are.
Suzanne Bueller at Board of Equalization. Basically, we initially send a billing to a taxpayer. 44 days later, we send a notice of demand, and on that notice of demand, we'd be telling them if they hadn't paid, we'd be assessing the fee. 90 days after that, we would assess a fee. At this point, our estimate is that the fee would be $345 per liability.
Okay. And this will go into effect January 1st?
That's correct.
2011. All right. Okay, I thought we'd go back then, unless there's some questions. We'll go back and go through them and allow for supporters and opponents to speak.
Just one comment. Senator Wilk, I certainly agree with your comment. I really like sunsets. We need lots more of them. We need opportunities to review what we're doing and how the economy has changed and how society has changed. Thank you.
Thank you. All right. I think Mr. Grinnell and Mr. Shea, you stay, and I'll ask. Thank you very much, BOE, FTB. We're first going to talk about again the order that we looked at them, the delay, the NOL suspension for 2 years, which I believe is the $1.2 billion the first year, and then declining to $205 million the last year. Is there anyone who wishes to speak either let's start in support of this or in opposition to this? All right. I don't see anybody. Are you coming? Come on down. Welcome.
Thank you, Madam Chair. Todd Bloomstein for the Southern California Contractors Association. Just briefly, and I'd like to say thank you to Colin for the explanation. We do have concerns with the net operating loss carryback, and it's specific to the construction industry and how it is struggling currently. And I'd like to give some figures for you and the committee to consider. In 2005, construction almost broke the $100 billion mark in actual dollars spent. Last year, 2009, it came in at $38.6 billion, a 60% reduction in actual construction spent in California. That represents nearly 300,000 out-of-state or out-of-work construction employees. That's a significant hit. Clearly, this is an industry that is suffering, but it does get worse. Because of the contraction in this segment of the economy, we've had more contractors competing for less work. This has driven the price down of construction. My contractors are engineering contractors. They've been bidding on jobs at 25% to 40% below the engineers' estimates. And those projects have been awarded at 25% to 40% below the engineer's estimate. So from our perspective, we are working at a loss. Our members are working at a loss to continue the cash flow. From your perspective, from the public owner's perspective, you're getting a heck of a deal on construction projects right now. So the point is, and as was referenced in some of the background information, there was a 2009 Congressional Research Service report that was published in November, and it said the intent of the net operating loss carryback carry forward provision is to give taxpayers the ability to smooth out changes in business income and therefore taxes over the business cycle. The construction industry is in the lowest it has ever seen of any construction business cycle. We don't think now is the time to eliminate or even suspend the carryback provision. And when you consider doing this, I mean, think about the construction industry and also consider the amount, the billions of dollars that the construction industry has sacrificed so that the public owners can have a savings. So we ask that you not do this in the budget, and we appreciate your time. Thank you. Thanks.
Yes, ma'am.
Estella Mew with the California Teachers Association. We have some concerns, some serious concerns with the cost of performance and the NOL and possibly others because, one, we haven't seen the language and we don't know if there are negative impacts with our current proposition that we're trying to get passed November 2nd, Proposition 24. So for those reasons, you know, we're just being very, we'd like to see the language, frankly, just to see what that interaction is.
All right.
Thank you.
I hear that. We do have an analysis. When will language be available?
I believe the Budget Committee is finishing the revisions today, hearing it in Conference Committee, and we'll release it after the Conference Committee later this afternoon.
Okay. All right. That was either support or opposition. First support, opposition. We'll now move on to the exception to the NOL suspension. Those who are in support should come forward.
Good morning, Madam Chair, Senator Alquist, Chris McKaylee on behalf of the Humboldt Redwood Company. We are in support of this provision. By way of background, similar to what is being proposed in this budget trailer bill, in September of 2008, the legislature adopted AB 1452, which went back to the 1st of January of 2008 and suspended the NOL deduction for the 2008 and 2009 tax years. In the summer of 2008, leading up to it, there was a 2-year process by which the Pacific Lumber Company had declared bankruptcy, and there were competing plans to pull that company out of bankruptcy. The state of California endorsed the proposal that was put forth by the Mendocino Redwood Company, essentially a sister company of Humboldt Redwood Company. On July the 31st, they exited bankruptcy, expecting to apply against a $265 million gain in excess of $315 million of net operating loss carry-forwards that Pacific Lumber had. This was an effort to end over 2 decades of strife in the town of Scotia, save over 200 sawmill jobs. Similar to Mendocino Redwood Company, Humboldt was able to secure FSC certification, which is the Forestry Stewardship Council, which is the most prestigious because of their strong record of proper forest management practices. 2 months after they exited bankruptcy, AB 1452 was signed by law by the governor September 30th, 2008, and made a retroactive tax law change. It was expressed by the legislature at the time, similar to the analysis here on page 14. By the way, a more detailed history is set forth in your analysis, pages 7 and 8, how we got to this situation. But as expressed here and in 2008, the suspension is merely a time value of money loss. In other words, the 2-year suspension will be tacked on at the back end, and so you'll still have your same carry forward period. So the state is, in essence, borrowing the time value of money from taxpayers. Unfortunately, because of the unique set of circumstances with this company exiting bankruptcy and utilizing those NOLs to offset a one-time revenue gain, because Palco had amassed hundreds of millions of dollars in losses trying to run that company in Scotia, which is why they were in bankruptcy, had the practical application of eliminating in toto their NOLs. So they were not merely losing the time value of money. Those NOLs were taken entirely from them. So what this measure would do, this provision, is say, with this unique set of circumstances, the application of AB 1452 is not applicable. Now, there's concern about potential revenue loss. A bill has been, a notice of proposed assessment, has been sent, i.e. a bill by the state of California. No dollars have been paid. This is not a refund check, someone has asked. This will be, if clarification to clear up this unintended consequence is not adopted, the issue will be litigated in bankruptcy court. Bankruptcy court to district court onto the Fifth Circuit Court of Appeal in Texas, which is where the bankruptcy itself took place. Pacific Lumber Company was headquartered in Texas. We in the state of California will return to bankruptcy court and the federal courts of appeal for many years to litigate this issue. Clearly, our belief is that with bankruptcy, all issues are extinguished at that time. The FTB thinks that because of the application of this law, you unfortunately got swept up into it. We sought clarification that it is not applicable because the net effect is taking away the NOLs, not merely suspending them.
I asked earlier of the FTB the value of this proposal, and they couldn't give me an answer. I'll ask you the value of this proposal.
The notice of proposed assessment, I've never seen a copy myself. I understand it's roughly $20 million plus penalties and interest. But this is not money that the state of California has, and there's no indication based upon our asking of the FTB whether or not this amount of money was scored in the revenue estimate of AB 1452. In other words, we don't believe that the state of California in 2008, September of 2008, was counting on this money.
Okay. Question of Mr. Shea or Mr. Grinnell. Are there other companies that fit into these circumstances that ran afoul of this situation?
It's
1452.
I asked Franchise Tax Board that question, and the confidentiality issue precluded them from being able to provide an answer. It's possible, I suppose, but it's impossible to tell whether or not there's a company that matches the exact circumstances of Humboldt Redwood Company.
Okay. All right. Any questions of Mr. McKaylee?
Just having visited Scotia and the knowing how it's dependent on the lumber industry, and I don't know if my comment really is for you, Mr. McKaylee, or for our consultants, but it almost sounds like this is a very specialized situation, and I know we can't get a handle on whether there are other companies in the same situation, but I just want to say that I know that we're talking about a lot of jobs and about a whole town, and I just wanted to make that comment.
Okay. All right. In opposition or further support? Anyone speak in favor of support, in support of this, and then we'll talk about opposition. Welcome.
My name is Chuck Bonham. I'm California Director for Trout Unlimited, which is the nation's oldest and largest trout, salmon, and steelhead conservation organization. I have two specific comments in support of Humboldt Redwood Company. First, in this unique instance, it's about more than jobs. It is also about a commitment to natural resources benefit. For over 10 years, Trout Unlimited, Mendocino Redwood Company, and Humboldt Redwood Company now have been engaged in a collaborative working relationship on the landscape to bring back our beleaguered coho salmon and steelhead salmon north of San Francisco. I know of no other corporate timber company that is engaged in a project across hundreds of thousands of acres to evaluate their landscape, identify migration barriers, remove those barriers, and more importantly, analyze their vast network of legacy roads, and then either decommission or improve those roads to prevent tens of thousands of dump trucks of new sediment entering these coastal streams. It is about more than jobs. It's also about environmental benefit in this unique situation. Second comment. This issue is also about honoring promises made. Trout Unlimited, in addition with 7 other organizations, supported the Humboldt Redwood Company during the bankruptcy debate and the policy debate about PALCO lands. Those other organizations included Sustainable Conservation, Rainforest Alliance, Conservation International, Pacific Forest Trust, EPIC, and the Sierra Club. That is a diversity of opinion in that list of supporters. Trout Unlimited issued its support for that bankruptcy proposal based on promises that Humboldt would bring improved protection and practices to these PALCO lands, that they would save Scotia and jobs, and that they would practice sustainable forestry. Those promises, in our judgment, have been met and exceeded to date. Thank you for the time to offer those 2 comments.
Thank you. All right, we have opposition. Come on down.
Jean Ross, Executive Director of the California Budget Project. And we'd like to say that it's wholly inappropriate to use the tax code to provide a significant benefit to a single company, particularly in a year when we are seeing very, very deep cuts to a whole range of public programs, community clinics, child care programs, and others. And to draw an analogy about the retroactivity, a lot of people had children last year, and they assumed when they started down the path to have those children that they were going to get a larger child tax credit. They lost that benefit retroactively, too. And so when laws change, there's collateral damage oftentimes, but I think it's inappropriate to single out one of the millions of taxpayers in California that did end up paying more unexpectedly for special treatment. Thank you.
We would just, Lenny Goldberg, California Tax Reform Association, we would just reflect that you're carving out for one particular company, whether you're a good actor or a bad actor, really, and I fully understand that they may be good actors on the environment and jobs and all that. So are many other companies that are caught in tax changes. There are always tax changes that always affect taxpayers. And if I may, at the pleasure of the chair, I do have to leave shortly, so I would just like to go on the record as also opposing the cost of performance change. I think that once you have one elective provision, which was the mistake that the legislature made the first time, and so we're compounding that mistake by giving another choice and another election. So I apologize for not being here for the full hearing, and thank you for your forbearance on that issue.
Thank you.
Janice Norman on behalf of the American Federation of State, County, and Municipal Employees, AFL-CIO. We're opposed to this measure as well. We think that it's unconscionable to think about suspending Proposition 98, having cuts to vital services to elderly and indigent individuals, and at the same time gifting millions of dollars to private companies.
Any further opposition on that particular, on the exemption? All right, moving on to the large corporate understatement penalty. Are there folks who want to come down in support of that? There was some question about whether this was retroactive or not. What is the determination?
It's not. It is 1/1/11 that takes effect. It's changed.
Thank you. Welcome.
Thank you. Good morning, Madam Chair, members of the committee. Greg Hines, California Manufacturers and Technology Association. I'd like to start out by thanking you, Madam Chair, and the members for actually holding this hearing today. It is a bit ironic that we are actually being able to have some transparency for the penalty fix. When you look at 2008, we saw the actual inception of the penalty not have any hearing at all. So I appreciate having the opportunity for us to at least have some conversation and review of that. I would also like to thank the leaders for their efforts to address what we believe to be a flaw in the initial penalty. Taxpayers, through no fault of their own, can get caught up in this understatement penalty due to its strict liability nature. When we passed this, again in the fall of 2008 budget, the strict liability was the first of its kind ever to be seen across any of the states, and it did unfairly capture taxpayers who may have had an audit go a different way, may have had foreign treasury versus U.S. federal treasury actions impact their federal AGI, which then triggered state tax liabilities that would be caught under this understatement penalty. Again, we think this 20% safe harbor helps to provide some reasonableness to this penalty. We have had many of hearings, as you know, Madam Chair, about whether a reasonable cause exception or the actual merits of the penalty itself. That is not for today, but we do thank you all for taking the effort to add some reason to this understatement penalty. With that, thank you.
Okay. And the strict liability standard remains, that's unchanged. All right. Further support? Opposition?
Jean Ross again with the California Budget Project. Deeply concerned about the revenue loss that will only widen an already gaping gap in the budget. We're particularly concerned that this provision was included in the 2008 or in a budget agreement which included a very large corporate tax reduction as well to ensure that taxes that are legitimately owed to California are actually paid in California. And particularly with the adoption of elective single sales factor apportionment, which is also a unique provision. We are the only state in the country that has annual election. We think it would be more appropriate to defer action on this penalty until after the resolution of Proposition 24, because we think that particularly with elective single sales factor apportionment, you will have a lot more opportunities to game the tax system, to not put too fine a point on it, and that it will be important to keep this penalty in place if that provision remains law in California, because we're concerned that the revenue loss that's before you may actually be a very low estimate given the potential for abusive, aggressive, choose your word tax planning on some of the corporations that would be covered by that provision.
Ms. Ross, don't leave yet. I have a question. You heard me ask about modifying in light of consequence, what happens with this. Do you have an opinion on, I'm just curious as to whether this would be majority or two-thirds to make further changes? I mean, it sounds as if we're going to need some kind of ledge council opinion about that.
I believe historically, and I would yield to your consultant, whose experience as a rev and tax consultant is a lot more recent than my own. I believe that historically penalties have been treated as a majority vote issue. Certainly, I am not legislative counsel. I would encourage you to seek the opinion of counsel in that regard. And I would say, and I'm not sure where to, I understand that you want to take where people have positions on differing issues in order. I think when you take the whole package together, the NOL suspension, which will bring it really is moving money to the state, where the state will not see as large a revenue loss in the next 2 years, but will have a larger revenue loss in the future. This provision, which increases over time the cost of performance rules, and I can speak to that right now if you want to avoid me jumping up and down as well, that I think you're setting this state up for future budget problems that will be larger than they otherwise would have been. And I think if you take that, and I know this will be heard in the budget committee, in the conference committee this afternoon with some of the aggressive revenue estimates, I think we are looking at a future that is very deeply troubling in terms of the kinds of budget problems that we'll see from actions like this, which don't bring in any real money, but simply push the state's problems out into the future.
I appreciate those general comments as well. Again, just trying to organize this.
Okay, I can wait on cost of performance if you'd rather.
I would.
Okay.
It's we're organizing it that way.
I appreciate
but that is not to prevent anyone who has a broader statement. I'll allow for that at the end. We have time, either in favor or opposed, whatever. All right. Corporate understatement. Opposition.
Just for the sake of time, Gina Snorman would ask me would associate myself with the comments that Gene just made.
All right. All right. Let's move on to the cost of performance issue. In support, please. The only way we're going to vote for this is if you can explain it.
Well, I can't explain it. Mike Ropes on behalf of Qualcomm, and I got to qualify my support here in that to the degree I even understand the provisions, and to the degree that our clients, has not seen language for the bill, and it's based on understanding of communications with them, and just in the last several hours. So really quick, Qualcomm's an in-state company. There's 11,000 employees in San Diego. They derive their income from intangibles, which is they license their technology, and that technology is the result of work that's done in California from their 11,000 employees in research and development. So to the degree I understand that's their income stream, as Mr. Grinnell points out in his analysis, Qualcomm elects single sales factor. They would always elect single sales factor. They would support a mandatory single sales factor, and they're on record as saying so.
That's true.
So to the degree that the language in the bill that we have yet to see, as Mr. Grinnell points out, they should be unaffected by this language because they elect single sales factor, and so they would continue to have the market rule, and the market rule is good for them. And so the important thing in the language, as I understand it, is that there will be some language in the bill to say that those who elect, in the case of Prop 24 passing, and that the single sales factor is repealed, you will continue to keep the market rule. Am I understanding that correct?
The bill that I analyzed has that language.
So that's what I support.
You'll be very busy after the conference committee.
So
go through all that.
So that is Qualcomm's support. As long as that's in the bill, they want the market rule, and that's important to them. It allows them to continue to make their investments in California, and continue to allow them to invest in on their own beyond what their regular tax contribution to California is, and the employment of people in California, to invest in the higher education system throughout the state, especially in San Diego. The UCs and the CSUs down there generate a lot of support from Qualcomm, and they want to continue to be a California-based business, and they want the tax rules to reflect that.
And I would like to pursue that a moment. Mr. Grinnell, in your analysis, you talked about what might happen in the future if this proposal is enacted. From the perspective of California versus non-California companies, what are we talking about? What can we say?
California versus non-California companies isn't probably the exact distinction you want to talk about. It's whether or not where the income-producing activity takes place. And a firm can be located in lots of different locations. Sure. And also keep in mind the cost of performance is calculated for every separate item of income. So a large diversified technology company may invest in income-producing activity in its printers in one state, but in its software in another. So it depends on where the income-producing activity takes place for that individual separate item of income. The example that I used in my analysis to try to demonstrate what the world would look like if the rules for assigning your intangible and service sales follows your sales factor election, it would essentially create some possible competitive inequities. If you are a firm that does its income-producing activity in California and single sales factor makes sense for you, your apportionment formula will be your sales factor. So whatever you sell in California as a percentage of your total worldwide or U.S. sales, that will be your apportionment formula. You can never get below what the actual market, what the market is for your product. The firm that doesn't attribute its income-producing activity to the state will be able to report a 0 on their sales factor if they don't do any income-producing activity within the state. So their sales factor will become 0. Having a 0 sales factor versus whatever your market sales factor is going to be a better environment for the firm that does its income-producing activity in another state as opposed to California. My analysis goes on to discuss that because the firm that has its cost of performance in other states, they will apportion under 3 factors. So if they invest in California, they will see higher apportionment formulas because the property and payroll factors go up. Sales factor would remain at 0. For the firm that does the income-producing activity within the state, their only remedy to be able to address the competitive disadvantage would be to move property and payroll from California to other states so that they can then elect 3 factor and can then avail themselves of cost of performance sourcing.
Senator Alquist.
Thank you. A question for Mr. Shea or Mr. Grinnell. What is the status of the language on the cost of performance? And the reason I ask is that any bill that I vote on should reflect the agreement reached by leadership. And I understand there's some disconnect at this point.
Yeah, well, the language has been drafted and slight revisions are occurring, and in large part the agreement addressed all the circumstances, and in perhaps the way Colin raised some policy concerns, my understanding of the budget agreement as it was reached was that last year's budget, the trailer bills SB and AB 3X15, which authorized the single sales factor election beginning in the 2011 tax year, would have has generally a beneficial effect for in-state companies, and as Colin indicated, the primary reason the cost of performance rule was changed was that under the existing cost of performance rule, all those sales of intangible goods and services from California companies to outside of California would have been sourced to California, and therefore would have counteracted the benefit of the single sales factor. However, in doing so, last year's agreement would have had the effect, beginning in 2011, of disadvantaging out-of-state companies that weren't going to elect the single sales factor, because rather than being under the cost of performance rule, all companies, whether they elect or not elect, would be under the new market sourcing rules. So, for instance, an out-of-state service provider, say a cable service or something, that was performing the cost of performance out of state and selling it into California, Under the old rule, that would be sourced out of state, but under the new rule taking effect in 2011, it would have been sourced in state, and so they would have had a disadvantageous tax situation. So the budget agreement was intended to mitigate that impact and allow the companies that were not electing, that are going to choose not to elect the single sales factor, to remain under the old cost of performance rule. I think that was the policy rationale for it, to not disadvantage them from a new election that they weren't going to exercise.
Well, just in closing, and I know what fine work, Mr. Shea, you do and Mr. Grinnell does, you use the phrase, in large part it reflects. And I would just want to be sure that, and I probably say this as a mathematician, but that I would want to be sure that the language 100% reflects the agreement reached by leadership. And there still seems to be a little an issue around that, and would appreciate being apprised. Thank you.
Okay. Thank you. Further in support of the cost of performance change proposal? All right. In opposition?
Jean Ross again with the California Budget Project. First and foremost, concerned with the revenue loss. Second, concerned with the creation of an incentive for California headquartered, California-based, largely present in California companies to move activities, property and payroll out of state in the manner that your consultant so eloquently and articulately described. We are very concerned with that issue. We're also very concerned, and I think this comes down to the problem of not having language. And this is a particularly complex area where the devil is certainly very much in the details. We're concerned that the way this provision, and also potentially the NOL suspension has been drafted, could potentially have interactions with Proposition 24, which will appear on the November 2nd ballot. Particularly concerned that the way this provision is structured would actually bring companies who at this point don't have an issue one way or another with that particular ballot measure, that this could actually give them an incentive to oppose something that heretofore they haven't opposed, and think that it is entirely appropriate and only right that language be made public on a timely basis, given that it would have a very profound impact on that measure. Thank you.
All right. Further opposition?
James Norman, on behalf of ASME, we would be in opposition to this measure as well. But we would suggest that you consider your comments earlier about putting sunsets on the last three proposals. We think it makes sense that if you have an agreement, that the agreement sort of has an air of fairness to it. And if you're sort of giving up permanent revenue increases, that you don't sort of exchange sort of temporary savings.
Okay, thank you. Further comments on this particular item? Are there any comments on the last two tax collection proposals involving the BOE? Welcome.
Thank you. Sheila Waters of the Board of Equalization.
Hopefully you're for them.
We are for one. The board, the board just hasn't had the opportunity to take the position. But the one the board is supportive of is making the use tax line permanent. We've seen an increase in the reporting since the line became on the return. It started out in 2004. We got 2.8 million. Now we're up to over 10 million, and we hope to see that grow each year. So that's the provision that the board has supported. The board just simply hasn't had the opportunity to take a position on the cost recovery fee.
All right, thank you.
You're welcome.
Anyone else want to speak to either one of those proposals? All right. I would now like to give the opportunity to anyone who wishes to make a more global statement in favor and support, whatever, before I turn to my colleagues. All right, seeing none, colleagues, any closing comments at all? All right, then I would just like to say thank you very much to our staff for excellent analysis. Reminding everyone that there is a budget, a conference committee this afternoon, before which there are to be analyses available. if not as we speak. And then actual text available after the conference committee meets, so probably around 5 o'clock. I want to thank everyone for coming, and that's it. Thank you.